Good morning, everybody, and a warm welcome to all of you who've joined us on this Friday morning. It is another one of our editions of our fund focus webinars, and today we're going to be specifically discussing the SA Equity Fund, managed by PSG Asset Management. This fund has done fantastic and has performed consistently well, finishing in the top quartile over the 1, 3, and 5-year periods. We all know equities can be very volatile and cyclical. And today we're privileged to have with us Sean Leroux, who's a senior fund manager at PSG Asset Management and an old hand at picking stocks. Good morning, Sean.
Good morning, Cyril. Thanks for calling me an old hand. It's making me feel quite old.
We're all getting old, mate, but you've been at this for a long, long time, and we're privileged to get your views on what it takes to manage an equity fund or manage a stock portfolio. And I've not only invited fund clients, I've also invited some equity clients who manage their own portfolios to get a bit of insight from you. Thank you very much for joining us. I've also got Sidwell, who's our senior funds analyst with PSG Investment Management, and he's going to be helping us. He's created some graphs for us and some comparisons, and we're also going to be firing some questions at him because he uses Sean's fund as one of the underlying funds in the stuff that they blend for us, specifically aimed at the retail clients, to make it easier for you to pick a fund, because it is difficult to pick out of a whole range of funds. Sidwell, morning and welcome to you.
Morning, Carol, and morning to you.
Thank you. I'm going to fire straight away, and I'm going to direct this at Sean. And I'm going to say, Sean, we've got funds across the risk spectrum, starting with money market funds, going into cautious money income funds, cautious, and then right at the top of the risk spectrum sits these equity funds, which are typically 100% invested in equities and that. Where does that fit in somebody's portfolio?
Yeah, so the simple answer is that equity funds are going to do the heavy lifting in terms of growing the client's capital. So if you go back basically to the year 1900, what is that, 120 years, domestic equities have given you inflation +7. And that's way ahead of any of the other comparable asset classes. So if you want to grow your capital over long periods of time, well ahead of inflation, you've got to be using equities and heavily using equities. But, there's a trick, and the trick is the reason that equities produce that kind of outcome is that this is clearly, one of the most volatile asset classes out there. You've got to be able to stomach those 20 or 30% down years, because effectively that's the ticket to the game. The fact that markets do go up and down and that inherent volatility is what allows equities to generate the capital growth, which we all need if we want to retire, if we want to stay ahead of inflation, if we want to build a nest egg. So equities are essential in that regard.
Is there a way that you guys apply that you can mitigate that risk somehow?
Yeah, look, the starting point is that, particularly with markets, futures are knowable. So what we've learned a long time ago is we don't make any predictions of what's going to happen over the short term. And we allow for the fact that volatility is to be expected. But what we want to do is we want to navigate that volatility as best we can. So if we can manage to the downside, and we like to do that by not owning expensive stocks. So we will try and avoid expensive stocks. But also what we're going to do is we're going to diversify across different sectors, portfolios, geographies, currencies, etc., to make sure we don't have all the eggs in one basket. But also, very, very importantly, we want to take advantage of the fear. So when markets do get fearful, they got very fearful in 2020, they got very fearful in the GFC. And actually, if you look in the South African context, the markets have been very fearful in the last few years. And PSG as a house likes to take advantage of the fear, because we've typically found that's when we find the best opportunities for capital growth for our clients.
So how do you then decide which stocks to include in these difficult times?
Yeah, so we've got a very structured, very disciplined, very rigorous process. We've done this for many, many years. And in essence, our process orientates us to having our clients having exposure to our best ideas, the stocks that, if you look probabilistically, are most likely to achieve those objectives of high returns without taking on significant risk. What this means in practice is we run what we refer to as our 3Ms. So with every single stock we look at, we're looking at through the lens of three specific M's. The first being moat, or competitive advantage, basically the inherent quality of a company. The second will be is management. So in other words, do they have a management team that is going to look after us as shareholders and grow our capital? And the third is margin of safety. What are we paying? And we always like to buy at quite a nice margin of safety, which speaks to the fact that we are going to get the odd one wrong. And it also speaks to the fact that if you buy cheaper, over long periods of time, your returns are typically higher. And that served us very well for a number of years. And we apply the same process in South Africa and offshore.
And obviously, you've said it a couple of times, is that the investor has to be in for the long haul because of the cyclicality and the difficulty of picking stocks in a portfolio. So very important for the investor to stay. And one of the objectives of the funds and the suitability of the fund also indicates that that it's aimed at growing capital over the long term, but you have to be in there for at least a period of 7 years. Sean, now
that's right. If I could just add something, it's just such an important point because, if you've been in the markets for a while, you know that your clients want to get out of equities, when there's a panic on, and often that's exactly the time you should be doing the opposite. And I'll just give you an example in current times is that, we've just had a big stimulus package coming through in China. Everyone has been so fearful of China. But in the space of literally 3 days, you've seen enormous moves. So if you'd been out of the market, you would have missed out on. And we've just seen it time and time again. We saw it same around our elections, etc. If you sat and you waited for the dust to settle and everything to be rosy, you've missed the return. So you need to be in the market for the long periods of time, and you need to embrace some of that fear that hits the markets from time to time.
Thanks. That's an incredibly important point, that because people tend to panic and liquidate assets when they shouldn't be. The other thing I wanted to talk to you, Sean, is you obviously invested in South African equities, and you hold stuff like Discovery, Absa, Raubex, and so on. Where do you see opportunities in the South African equity market post the government of national unity?
Yeah, it's been a very interesting journey the last few years. South African assets have been trading at what we refer to as crisis valuations. That means they basically, in recent times, have got as cheap as they got during COVID and in the global financial crisis. So basically, they got as cheap as they've ever been. And that's because both the locals and the offshore investors had been net sellers for many years in a row. And on the local side, the guys had predominantly gone offshore. And that's because the US in particular was doing extremely well and South African stocks were doing poorly. What we've been doing for several years now is, on a selective basis, when we can find good opportunities in the local market amidst some of this fear and crisis. Remember, a year ago, we were in the midst of deep load shedding, and it was a very dark time. So what we would have been doing at the time is adding capital to some of these out of favor, in many cases, higher quality companies. So a good example would be middle of last year, we had very acute load shedding. We'd just been through the Lady R episodes, and in May of last year, the Rand dollar blows out to close to 20 Rands to the dollar. A lot of fear around. We would have viewed it as an opportunity to look at something like apparel retailers, and we would have bought a company like Foschini in the months that followed. Similarly, through this election process that we've had, there was a lot of fear. There were potential bad outcomes, and one needed to think properly about what that might mean for your portfolio and make sure you were adequately diversified. But when the opportunity arose to invest in companies that were trading at those crisis valuations, where we thought the market was very slow to come around to the fact that South Africa was likely to turn for the better under the circumstances, we continue to add capital into that space. And you've mentioned a few names. So we would, Discovery would be a core holding of ours. We have a healthy bank exposure through Standard Bank and ABSA. We also have I spoke about the apparel retailers in the form of Fashidi and Pepkor. We also have very healthy mid-cap exposure, and that's been a sweet spot for PSG Asset Management over essentially over 2 decades, where we can leverage the fact that we're not the biggest managers in the market. We would call ourselves medium size, and some of the managers out there, the Allan Greys and Coronations of the world, are absolutely massive. And that means in practice is they're very restricted in terms of where they can invest on the JSE. And we want to leverage our stock picking capability, and often some of our best ideas come from the mid or small cap sectors. And you referenced Rabex. Our clients have done exceptionally well over the last year out of some of the construction infrastructure players, Rabex, WBHO, to a lesser extent, Afrimat. And that would be a great sweet spot for us, where we can buy these companies when there's been a lot of fear around. We can buy them really cheap, and we can see things turning for the better. And that's played quite a meaningful part in the performance this fund has generated.
So something that as you were talking, I was listening and I was hearing a theme of diversification across sectors. You obviously apply that to a great extent and don't only chase after one sector when the market turns into a specific direction because of a macro movement and so on, but you rather apply a philosophy of diversifying across all the sectors. Now, Sid, you guys then take these funds that Sean and them create, and you blend them into a fund of funds structure, blending these different philosophies from these fund managers into a product where a client can benefit from different views, more diversification. But how do you do it? How do you typically use a fund like Sean's SA Equity Fund in the blend that you create for our clients?
That's a good question, Sarel, and thank you for it. So we have 2 main levers that we use. We have a fixed income allocation, and we have an equity allocation. Where Sean's fund sits is within the equity allocation, or the equity building block that we use in the fund. Currently, the allocation to the fund is approximately 73% of the total fund. And that reflects our high conviction in domestic assets being an opportunity which we feel that we can benefit from in the long term. And primarily, the role that it plays is that of not just generating capital growth, but also of providing dividends. This will always be our primary allocation within the fund. And we understand that over the long term, there will be those fluctuations. And that's where the fixed income allocation comes into play. Over the short term, it will provide a bit of stability. But over the long term, as Sean mentioned, the equity allocation will do most of the heavy lifting and provide the capital growth we seek to generate in the fund.
Okay, so you're trying to, because you are restricted to Regulation 28 and you've got to adhere to those restrictions, and you're also creating more of a balanced fund, you're using an equity component and an income component. We've actually got a slide of that that shows that. No, not that one. That one there. Yeah. Yes. So you've got an equity allocation on the one side, fixed income on the other side, and you blend those two in order to make sure that you stay within the bounds of Reg 28, and then obviously also to get a slightly less aggressive fund structure than what Sean's SA Equity Fund only would be.
That is
very,
correct.
very interesting. And then, Sid, well, when you guys sit down and decide what percentage goes where and so on, I mean, you've obviously got a committee like Sean and them as well, and you probably also apply the principles like he applies, the moat and the management and everything, to the way that you pick funds that go into your blends.
That is correct. So for us, our process centers around three things. One, we look at the valuations of the various asset classes relative to each other. And that is the primary means by which we determine whether or not we're going to allocate to local assets or we're going to allocate to offshore assets. Based on our recent analysis, we looked at the valuations of domestic assets relative to offshore and came to the conclusion that domestic assets were quite attractively priced and are where we should allocate the bulk of our allocation. Now, one thing that needs to be stressed is that there tends to be a perception that because our allocation to equities is locally, that means that there is no offshore exposure. How we access that offshore exposure is through locally listed companies that have a significant allocation of their revenues offshore, and that is able to provide a bit of diversification. And Sean might have a bit of more color on that. So, for example, the likes of AB InBev are listed locally, but do derive a significant amount of their revenue offshore. So we do have a bit of offshore exposure through locally listed equities. That's number one. Number two, we do try to minimize risk. And the way that we define risk is not necessarily through the short-term fluctuation of asset prices. We look at risk as the likelihood that over the long term, you are not going to be able to achieve an inflation-beating return. So that's why we look at opportunities which we believe by allocating to can help the client reach that objective. And forward-looking, we believe that we have found those opportunities and we are positioned to do that for our clients.
Great, thanks for that explanation. So you're combining views from different asset managers. You've got your own view on whether local or offshore assets are best to invest in at the time. So it's really getting more and more diversification in the fund structure. But from the sound of it, both you guys are fairly bullish about SA Inc. And I must say I am too, because I'm sensing it in my interactions with clients every day. There's something underlying that's changed, post this government of national unity. And I think the fact that load shedding has subsided to a great extent, we don't know whether it's going to come back. I'm kind of pessimistic to think that it's gone forever, because the demand is just so high. But in the meantime, I think there's a positive sentiment around South Africa and SA Inc. And Sean, maybe you can tell us what you think and what you expect going forward for SA Inc.
Yeah, we've done a lot of work in this regard, and I think the key thing to acknowledge at this point is the base is low. So we're coming from a low point. So as you suggest, load shedding has been a big headwind for our economy and a lot of the companies we invest in. But we've also had consumer in really tough space, and interest rates have been high and they're starting to go down. So from a cycle perspective, things are looking up. But then if we talk to the government of national unity, this is very, very important. And I think the key thing for clients to understand about the government of national unity is the degree to which they have prioritized reform and creating growth in this economy. And all the indicators we've seen thus far are very clear that is right at the top of the objective list, and it's regardless of whichever political party you come from. And in conjunction with that, we've got the President's Office via Operation Vulindlela running what is already proving to be quite an effective process towards bringing government and business together to fast track certain areas to get the economy going and to actually remove some of the obstacles. And it's just starting with Eskom. I mean, there's been tremendous success in that regard. I mean, the Eskom story is contrary to all of our expectations, has actually been a good news story. And we're seeing the opportunity for that to be replicated in other parts of the economy. Obviously, Transnet is well underway, but unfortunately, that's going to actually fix the Transnet volumes is going to take some time, but the structures are being improved, and we're seeing good improvements in visas, etc., etc. But the key ingredient is all of this tends to work together. So we've come from a period of very low confidence and very high interest rates, and as economic growth, as the economy starts to move forward, and we see interest rates going down, and we see confidence coming up, that tends to feed on itself. And we see all the ingredients in place for people to be surprised by the fact that the South African economy could actually start growing from here. Now, there are risks. We're not sitting here and saying this is a done deal. And we have to acknowledge that it's a key requirement is that the government of national unity holds together. We think it's very unlikely that it doesn't. And the primary reason for that is that the incentives to not leave the government of national unity are high because everyone understands the consequences. So we think it's a low probability outcome that it won't hold. And in terms of the evidence we're currently seeing, it's very, very positive. And looking into the specific companies we invested in, we need to be honest that the missing ingredient at this stage is growth. And even up until a few months ago, the companies we've interacted with have said, that the economy has still been very, very weak. But they are starting to sound a cautiously optimistic tone that things are starting to look up. They are starting to see green shoots. So we're holding our thumbs. The good news is South African stocks still aren't expensive. So, we don't have to stick our necks out and say that these companies need to grow their earnings by 30% a year to justify their current valuations. We think they'll actually do fine in more of this kind of muddle through scenario. But if we do get some growth, we think there's a long way to go for some of these SA equities.
Fantastic. I also think South African equities have got great potential. And I think you guys are correctly positioned to make the most of that. Just a reminder for the clients that when you're picking a fund, it's we're going to go into some performance numbers now, and important to remember that you don't pick a fund on performance only, and you have to consider the philosophy of the asset manager. And today we've been privileged to hear how Sean picks funds and so on. And you have to go for a fund manager or a fund that has consistently delivered top quartile returns, because that's the way you beat the market. It's very, very hard to pick stocks, as Sean has alluded. It's also very hard to pick a fund that's right at the bottom and that's going to start running like mad and make you a lot of money. It's best to go with a fund that's been consistent and delivers consistent returns, and that's the way you create wealth. Sean, thank you very much. That's been very, very interesting. I'm going to open the floor now for Q&A. So I want to invite the audience to type their comments or their questions in the comment section, and then I'll direct them at the speakers. But before we do that, Sidwell's prepared 1 or 2 slides for us just to give you guys an idea of what sort of returns these portfolios, these professional fund managers are making. So if we'll just bring up that slide for us. So if we look at the PSG Investment Management Growth Fund of Funds, that's compared to the benchmark of the South African Multi-Asset High Equity Funds. And it's beaten that by quite some margin. If you go down to the next slide, I can show you that the investment management fund has also outperformed the peers. If we look at the other balanced funds out there, like 91 Opportunity, Allan Gray Balanced, and so on. So it's really been a success story for this blend of funds that we created, aimed specifically at the retail market where clients find it difficult to pick the right fund to be in. And I think the last slide, let me just see, the last slide has it in a table format. I think I've got one more slide that shows Sean's numbers. Let me just see that. No, not that one. Sean's numbers are on a different table. Be that, yeah, there. I think it was there. I think I had it there. There we go. So we can see there that SA Equity Fund has delivered over the 5-year period a significant return, beating inflation by quite some margin, and it has done so over a very, very long period of time. And it's beaten the general sector average. It's beaten the all share. So it really does make a difference to pick stocks. And Sean has given us some ideas on how to pick stocks and how to think about it, looking at the management and the moat and so on, and the philosophy that they follow. So I just wanted to highlight these numbers for you, because I always get the question from clients, so how much money do I make with this fund? You know, if I invest in Sean's equity fund, what's my return going to be? And future returns, you know, can't be based on what was delivered historically. So unfortunately, it's hard to predict the future, like Sean said. But to pick a good fund manager and sit and stick it out and align your objective to what the objective of the fund is the best recipe to achieve success in your portfolio. I'm going to hop straight into the comment section here. Let's see if we got any questions here. Swadesh says, please share the performance figures I just did. Okay, so Swadesh, I hope that answers your question. The performance figures of Sean's equity fund is impressive in light of what South Africa Inc. has done over the last couple of years. It's been very, very good. And then taking that fund and blending it into our own investment management growth fund has also, this fund has been a key component, and it has helped us to outperform our peers. All right, Swadesh gives us a thumbs up there. Let's see if there's any further questions. Guys, if you want to fire away at Sean now, this is your opportunity. You've got an experienced hand able to answer the questions that you have. So let's see if anything comes up. No questions. Sean, I think you were so comprehensive that you've answered all the questions. And I mean, all the questions that I asked was probably in the forefront of mind for the clients. Let's see if there's anything else. Otherwise, we're going to close the call. No, there's nothing coming. Sean, it's been a pleasure listening to you. It's obvious from your years of experience that you think of a lot more than just picking a single stock, combining all these other things that you cognizant of into your philosophy, blending it, and then sticking to a fixed recipe, you know, to deliver consistent returns over time. Thanks very much for spending time with us this morning. We appreciate that. Sidwell, thanks for compiling those slides for us, and thank you for your view on how you blend these funds. If you have any questions, please contact me or any of the investment specialists in my team, and we'll gladly help you select a fund that fits your specific goal and need, so that we, as I've said, align your objective with what the fund's objective is, because that's how you're more likely to get to your end destination and your goal. Thanks for joining us today, guys. I really do appreciate it, and it's been fun listening to you, Sean. Thanks very much for joining.
Thank you, guys. That was great.
Thank you. Bye-bye.
Thank you.
I know.
Bye.